Chris Roberts here with Sterling Rhino Capital, and today we're going to talk about the anatomy of a multifamily apartment syndication. Have you ever wondered who owns all those larger apartment buildings and retail establishments in your neighborhood and thought to yourself, wow, the people who own these things must be filthy rich? Well, believe it or not, the people who own the vast majority of those big commercial buildings are people just like you and me. And in this video, I'll share with you exactly how they do it and how by teaming up, you can too. Our investors have used this investing strategy, and I'm about to show you how to build wealth for your family and create ongoing monthly passive cash flow without having to do any work. So let's get into the details. When I was a kid, my parents were hardworking, blue-collar employees who could not afford to buy a home of their own. They just continued to rent year after year, and as a result, it never occurred to me that somebody actually owned those apartment complexes we lived in. I just thought the people on TV owned them. Celebrities, people with all the money. But I was completely wrong. As I learned at a later age, the majority of large commercial real estate is owned not by single individuals, but by groups of investors, often called syndicators. Now, you might have heard of a TV syndication before, which is basically when content gets pulled together. And a real estate syndication is similar in that it's a group of people that pools their ideas and efforts with a single purpose in mind to put something together. And in this case, it's investor capital. So instead of you taking your money to buy an individual rental property, you pool your money together with a group of other investors and you buy something together. Only now, instead of single-family homes, you're buying something much bigger like an apartment complex. And because you're investing together, you share in the ownership as well as the returns, which we'll cover later. Let me walk you through an example. Say that the lead group, also referred to as a sponsor team, finds an apartment complex listed for $5 million. They need about $1.5 million for the down payment, and let's say another $1.5 million for renovations to improve the property. So altogether, they need $3 million. Most individuals don't have $3 million to put down. So instead, the sponsor team or general partner team decides to form a syndication and invite passive investors to join the project. Maybe I put in $50,000, maybe you put in $100,000, and so on, and we're all passive investors. The sponsor or general partner team are the active partners because they have an active role in managing the project, depending on the total amount needed. Sometimes the real estate syndication can have hundreds of passive investors. So then the group creates an entity, often known as an LLC. And the passive investors will all join that LLC. They would also employ a syndication attorney to create the private placement memorandum, which is a legal document that outlines things like how the investors are tied to the investment, the risk involved, and other things like that. Because the LLC is a pass-through entity, you'll get the benefits of direct ownership in that underlying real estate asset, which makes it more beneficial than a REIT. But we'll talk about REITs later. One important thing to know about real estate syndications is that they are long-term investment strategies with an average investment hold time of 5 to 10 years. But in some cases, some of that capital can be returned early. So let's say you want to invest in a syndication with a project hold time of 5 years. Once you invest your money, you should expect not to see that original investment until the property is sold. This means if you invest $50,000, you shouldn't plan on that money coming out for a while. Not the next month, not even the next year sometimes. This is one of the reasons why real estate syndications is different from stocks and bonds, which are more of a liquid investment. Side note on stocks. While you can pull your money out of the stock market at any time, you may be subject to severe tax penalties. Now back to syndications. You should only invest in syndications with money that you don't need for a while. Now let's cover how much you might be expected to invest in a syndication. While the minimum investments for real estate syndications can vary, the minimum investment that is most common is $50,000. This means that you can invest any amount at or above $50,000, typically in increments of $5,000. And what about the returns? You're wondering how much money you can actually make through investing in real estate syndications. That's a great question, and the answer depends on the individual syndication, how it's structured, and other factors. But let's take a look at an example and give you a general benchmark for what to expect. Let's say you are investing in an apartment building syndication with a projected 5-year hold. Annual average cash flow returns of about 7% cash on cash, or 20% overall annual, and 2 times equity multiple. Now let's break down what that all means. Assuming you invest $50,000 in a syndication with a projected annual cash flow of 7%, that means you could expect a 7% return on your original investment per year. In that case, it would be about $3,500, paid out at $291 a month. Over a period of 5 years, this sums up to $17,500 in cash flow. And then there's the profit from the sale of the property in the 5th year, with an equity multiple of 2 times, which means that you're projected to double your money during the 5-year hold time. And this adds up both the cash flow and the capital return at the end. In other words, by the end of the investment, you would have received your original $50,000 investment money back, $17,500 in cash flow returns during that period of 5 years, plus another $32,500 in profits from the sale of the asset. When you add all that up, the original was $50,000, you have returned $100,000 in the span of 5 years. Another way to think about it is if you take the $50,000 in profits and divide it up by 5 years, and that's the holding period. That would give you an annual average return of about 20%, which is really nice. Here are the numbers again. $50,000 invested, 7% monthly return for 5 years, a share of the upside forced appreciation or value of the building based on income it's producing at resale, and the average annual return ends up at about 20%. I get it, it's a lot of information. So let's close your eyes for a few seconds while I play this video of a sandy beach and crashing waves, so you can go back to your happy place. Now, you ready? All right, let's go. Now you know what a real estate syndication is, what it's used for and how it works, and what the projected returns are. Now just a bit more information that you need to know. One of the best kept secrets in real estate investing is that you can invest in real estate syndications with retirement funds. Did you know that? That's right. The money that's sitting in your retirement fund can be used to invest in real estate syndications. Now you need to first roll those funds into an account called a self-directed IRA or a solo 401k. You can also invest it in or transfer it into a QRP. And that's a rollover process that's pretty straightforward. We'll talk about the differences between the two in a different video. But regardless of what you learn here, you should always discuss these options with your CPA. Once you roll your funds into a solo 401k or QRP, which is a qualified retirement plan, you can use those funds to invest in real estate syndications. Another important thing to know is that because you're investing in an LLC, which is a pass-through entity, you will get all the tax benefits of investing in real estate, which can be substantial. We're not going to dive into all that right now in corporate structure, but I do recommend you talk to your CPA to learn more about the tax benefits of investing in real estate syndications. And finally, you may be asking yourself if real estate syndications are the right investment option and strategy for you. Here are some things to consider. Because this is a long-term investment strategy, you should only invest in real estate syndications with money that you don't need for a while. Also, if you only have $50,000 in your bank account, please don't invest all of it into a syndication. You should first focus on making sure you have the things like emergency funds, adequate savings accounts, and probably some other type of liquid investment before investing in a long-term illiquid project like a real estate syndication. What real estate syndications are really good for is helping you invest your money into real estate without having to deal with the hassles of being a landlord. You get to just put your money in, sit back, and collect cash flow distribution checks while relaxing. Syndications can also be a really great diversification vehicle since you don't need to take the time to build up your own team or go out and look at individual properties. Syndications can make it really easy to invest in a number of different asset classes and even in areas of the country you never thought you could buy in. One more thing to consider though. I want to stress how important it is to find a good sponsorship team to invest with. Now, just about anyone can make a syndication look decent on paper. So you need to look beyond the projected numbers to really dig into the sponsor's track record to see how their other projects are performing and whether they have what it takes to execute the business plan on this investment opportunity. You need to trust but verify to the best of your ability. Well, there you go. Now you know what a real estate syndication is, how it works, how to check if they're a good fit for you, and the projected returns you can expect. There are also some things to watch out for that we covered. You know, when I started in this business, I invested in syndications, and it helped me to better understand the many advantages of this investment vehicle. It's created substantial passive cash flow coming in every month, and unlike my single-family rentals and duplexes, we don't have to do any of the work. So it's truly passive, which means I get to spend more time with my family. Now, I'm sure this video has answered many of the basic questions for you, but it may have sparked a lot of new ones. So let's keep the conversation going. Do me a favor and comment below, and let me know what your questions are. If you'd like a more detailed walkthrough of passive investing through real estate, just fill out our Investor Club form at sterlingrhinocapital.com. And if you like this video, hit the like button, share it with your friends, and be sure to subscribe. I'm Chris Roberts. Thank you for watching, and make it a great day.